Let's talk about inventory and accounts payable. Inventory is a current asset, whereas accounts payable is a current liability. Sometimes a firm will buy inventory on account. So when this occurs, our inventory is going to go up, so we debit inventory. But because they're buying account, that means they're not paying their suppliers immediately. Instead, they'll owe their suppliers some money, and we'll call that an accounts payable account. When the firm sells inventory, their inventory is going to go down, so we'll credit inventory. And we will debit the inventory expense account, and this has a very specific name called cost of goods sold. When firms make payments to their suppliers, their cash is going to go down, so we credit cash. And now they have less obligations, so we'll debit accounts payable. Now let's take a look at the inventory T account. Because inventory is an asset, the beginning balance is on the left-hand side or the debit side. When the firm makes any sort of purchase on account, the amount that's paid towards the purchase goes onto the left-hand side of the T account. When the firm sells their goods, then the inventory will go down by the amount that's recorded into cost of goods sold, and hence we'll put that amount on the right hand or the credit side of our inventory T account. Now we can figure out the ending balance, and the ending balance will be on the debit side of our inventory T account. Let's take a look at our accounts payable. Because it is a liability account, the beginning balance will be on the right-hand side of the T account. When we make a purchase of inventory on account, the amount is written in the right-hand side of the accounts payable T account. When we pay our suppliers with cash, then our cash payments gets written on the left-hand side of our accounts payable T account. We can once again find the ending balance, and the ending balance will be on the right-hand side of our accounts payable T account. Putting them together, we notice that both of them have the same purchases. We can also figure out the inventory as well as accounts payable formula. For inventory, beginning inventory plus purchases minus cost of goods sold equals ending inventory. For accounts payable, beginning accounts payable plus purchases minus cash payments equals ending accounts payable. So let's work on an example together. BiteSizeQ&A company reports its cost of goods sold as $15 billion in year 2. It has $4 billion in inventory and reports accounts payable at $3 billion at the end of year 2. At the end of year 1, ending inventory was reported at $3 billion and accounts payable was $5 billion. How much cash was paid to supplier for year 2? Let's use our inventory and accounts payable T accounts and work them one by one. First, BiteSizeQ&A company reports its cost of goods sold as $15 billion in year 2. We notice that cost of goods sold amount is found in our inventory T account, and we are given that it is $15 billion. It has $4 billion in inventory and reports accounts payable at $3 billion at the end of year 2. This means that we're given the ending balance. For the ending balance, we can now record the amount. It is 4 for inventory and 3 for accounts payable. At the end of year 1, ending inventory was reported at $3 billion and accounts payable was $5 billion. Remember, ending balance of year 1 becomes beginning balance for year 2. Hence, this is telling us the beginning balance. For inventory, it is $3 billion, and for accounts payable, it is $5 billion. So what do we notice? For the inventory T account, we have 3 out of the 4 necessary numbers for calculation. So we have beginning inventory plus purchases minus cost of goods sold equals ending inventory, which means 3 plus purchases minus 15 equals 4. And if we were to solve this, we would find that purchases equals $16 billion. Remember, when we made the purchase of inventory on account, we debit inventory for 16. That means we must credit accounts payable for 16 as well. So we can record 16 for the accounts payable T account under purchases. Now what do we notice? Under the accounts payable T account, we have 3 out of the 4 numbers. So we can finally solve for the cash that was paid to our suppliers using the accounts payable formula. Beginning accounts payable plus purchases minus payments equals ending accounts payable. So 5 plus 16 minus cash payments equals 3. This means the cash payments must be $18 billion. So as you can see, inventory and accounts payable are related to each other, mostly through the purchase of the inventory on account.